So, welcome back, friends. The credit markets in the United States have become weirdly confident despite so many threats to the global economy and to the United States economy as well. The gap between the US companies' borrowing costs and the US Treasury yields has shrunk to its smallest since 1998 after a red hot rally in the global credit markets that investors warn is underplaying threats to the wider global economy. The cost of borrowing for the investment grade companies in the United States and Eurozone credit markets is 0.75 and 0.76 percentage points above the benchmark government bond yields, respectively. This took spreads in these two markets, a proxy for the risk of default, on Friday to their lowest level since 1998 and 2018 respectively. Falling trade tensions after a number of US deals with the partners such as the European Union have fed optimism that a worst case scenario global trade war can be averted, improving the outlook for the corporate sector. But the investors should be warned that a sharp rally in credit is another signal after stocks rebounded to record highs that market optimism has become overstretched at a time when the US tariffs are climbing to the highest level since the 1930s and the jobs data has worsened. The credit markets are again weirdly confident that the global economy is going to be just fine, and one doesn't know why so much of confidence. You just don't seem to be getting paid that much for taking an equivalent amount of risk. Some even warn of a dissonance between credit and rates markets, which are expecting 5 quarter point interest rate cuts by the US Federal Reserve by the end of next year, anticipating that a central bank will have to act to support a slowing US economy. US jobs and inflation data over the coming months will be closely watched for signs that the trade war is creating economic damage. And the credit market is telling you that there is no growth issue, that the rates market is telling you that there is a little bit of a concern. The two aren't quite matching up. In a recent note, analysts at Goldman Sachs said that US and the European credit markets had largely shrugged off the different growth outlooks in a highly overly correlated rally. Credit spreads tightened sharply at the end of last year as optimism grew that the Fed would be able to tame inflation without pushing the economy into recession. But they widened early this year as President Donald Trump's Liberation Day tariff announcements sent shockwaves through the global markets. If you recollect, after that the bond markets plummeted and President Trump had to come back immediately and he had to put a pause on the tariffs. A series of trade deals with Japan, United Kingdom and European Union has eased the trade war fears. US companies have taken advantage of tight spreads to borrow heavily this year, issuing the second most highly rated debt in the first half of a year on record at $910 billion, even with April's trade war lull. One would have to wait and see what happens over the next few months. I believe that the credit spreads, which have so much narrowed, can widen once again once there is some nervousness that comes into the world system. And that can happen sooner than you would imagine. So be on your guard and wait for the widening of the credit spreads between the government bonds and the corporate bonds to happen in the near future. As to when this can happen and how the markets can react, do join our Prime Plus Telegram group, which are specifically addressed for the US markets. You can do that by WhatsApping us on 732-732-2720 for the Indian markets. You can WhatsApp us on 982-086-1044. Have a great investing week ahead. Take care. Bye-bye.